You've seen it. Headlines announce terrible economic numbers, factory closures, and rising unemployment. And at the exact same moment, the stock market decides to rally. Markets function as discounting mechanisms, pricing in future conditions long before they materialize in current data. That is why relying on official economic metrics, like gross domestic product, is a trap. By the time a GDP report hits the press, the economic activity measured has already happened, been fully digested, and priced in by institutional players. Basing your portfolio decisions on GDP is exactly like driving a car down the highway by staring exclusively into the rearview mirror. You are perfectly aware of where you've been, but completely blind to the curve ahead. The mainstream financial media reinforces this blind spot through the idea of linear progress. We are taught to look for steady, consistent year-over-year growth, as if the economy moves in a perfectly straight line. This diagram compares that expectation of steady growth on the left with the actual cyclical reality on the right. The global economy breathes in recognizable waves, moving in distinct pulses of acceleration and deceleration. To survive and generate returns in macro investing, you have to let go of outdated data. The edge goes to those who track these underlying pulses and anticipate the next wave before it ever becomes a headline. Within the logic macro regime framework, we call this underlying pulse the G pillar, which stands for the growth cycle. It acts as a fundamental current moving beneath the surface of the financial markets. To track this current, institutional researchers rely on leading economic indicators, or LEIs. These are specific economic variables that reliably shift direction months before the broader economy actually turns. This pipeline schematic tracks these shifts. The first valve opens for manufacturing new orders and housing starts, triggering credit expansion. A second input measures the yield curve spread, the difference between immediate capital costs and long-term expectations for growth. While those metrics track production and credit, the consumer remains the primary engine of the business cycle in the developed world. Their behavior dictates the vast majority of economic activity. This scale compares discretionary spending on wants against staples, the essential needs. When markets favor discretionary stocks over staples, it signals that investors anticipate a surge in economic momentum and a loosening of the household purse strings. Tracking these consumer spending intentions reveals the path of the cycle months before official retail sales data can confirm the trend. All of these indicators measure a mechanical truth about the economy. Every single time a person spends a dollar, that exact dollar becomes someone else's income. When consumer spending increases, companies see higher revenues. Since their fixed costs stay the same, those extra sales expand their profit margins. This feedback loop tracks revenues flowing into hiring, boosting household confidence and consumer spending. This momentum travels chronologically along a waveform. The highlight traces the recovery into expansion. Eventually, growth stalls, moving across the peak, down through contraction, and settling at the trough. By identifying these phases via leading indicators, you can see precisely where the economy is in real time. In macro investing, the direction of travel matters far more than the current destination. The G pillar doesn't operate in a vacuum. The momentum of this growth cycle directly dictates the overarching macro regime of the financial markets. This matrix shows portfolio implications. When growth accelerates, the environment aligns with Goldilocks or reflation regimes, creating a tailwind for risk assets. Conversely, when growth decelerates, the matrix shifts toward inflation or deflation regimes, requiring immediate defensive portfolio positioning. Regime shifts generally announce themselves through the peak and rollover of leading indicators, arriving well before a recession becomes a news headline. Applying systematic macro thinking allows an investor to remain focused on data-driven signals. It acts as a bridge between market chaos and investment clarity. Mastering the growth cycle allows for a transition from reacting to lagging headlines to anticipating shifts through data. By focusing on the underlying waves of growth, an investor can align their portfolio with the current regime before the market narrative catches up.